If you thought the stock market bubble was bad, let me tell you about the housing market bubble. Because as I've entered into a period of looking to actually buy a new house, I've actually started to realise just how ridiculous the housing market is. Because house prices are still continuing to defy expectations, as the average house price is now £294,845, which is roughly about $350,000. And that's despite the fact that mortgage borrowing has actually fell by 36%, home buyer demand also continues to fall, and there's also been multiple interest rate hikes, which are inevitably causing mortgage rates to go up. Which I guess leads me, as well as probably many of you guys, onto the question around whether the housing market is actually on the cusp of a collapse. Well, in today's video, let's take a look at the housing market. We'll discuss just how much house prices could potentially fall. We'll also discuss whether they could inevitably trend in the same direction as the broader stock market, and if so, potentially give us all half a chance of being able to afford a half-decent home. But before I do that, guys, for those of you who are new around here, my name is Mitch. I post all kinds of videos, usually on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below. So I'll drop a like on the video, guys. Really helps out the channel. With that being said, let's begin. Now, in order to speak about the housing market, first we need to understand how it all works. And let me be honest, it is fairly simple. It's pretty much a function of supply and demand. Now, of course, when you have something in limited supply but high demand, prices obviously go up. Now, on the supply side, unfortunately for us over here in the UK, we live on an island. So on a macro level, there will always be a scarcity of land. And therefore, as long as people want to still live in the UK, then technically speaking, land as well as home prices will continue to rise. However, when we dive into the details, there is actually a shortage of new homes being built. Thanks to the pandemic, we saw record low home completions during 2020, with less than 20,000 homes being built. And even up until most recent data, despite there being a bit of a flurry of new homes being built, now we're starting to trend back in the downward direction. And that's largely thanks to uncertain as well as rising material costs, as well as broad supply chain issues too. It's making builders have tighter budgets along with delayed schedules, which inevitably is resulting in fewer homes being built. Now, aside from that, thanks to the stamp duty land tax holiday, which the UK government put in place during the pandemic in order to prop up the property market, that of course did drastically increase the supply of properties which were going on for sale, along with psychologically increasing people's budgets because they knew that they didn't have to pay the stamp duty, which can be anything up to about 12% depending on how expensive your property is. And as a result, there was a huge influx of property supply coming onto the market, with the market actually peaking in transactions around March time, along with June and September last year, seeing well over 200,000 transactions taking place. Whereas now, as you can see, transactions have massively stabilised. And in actual fact, a large chunk of the UK have actually started to see a reduction in the total number of transactions taking place, with Birmingham, where I'm from, being down 15% from the prior year. However, some other areas are certainly worsely impacted, with the likes of Milton Keynes seeing a 30% reduction in total transactions taking place. So we've almost gone through a very quick period of a major property boom, with a sudden flurry of activity triggered by the stamp duty land tax holiday, and now we're seeing a shortage of properties on the market, which is equally propping up their prices. I guess we've certainly triggered the extremities of market conditions, specifically on the supply side, which without doubt will certainly create a volatile property market. Then on the flip side and the other side of the equation, you have property demand, which is certainly interesting because one of the directors over on Rightmove recently published the exceptional pace of the market is easing a little, as demand gradually softens and price rises begin to slow, which is very much to be expected given the many record-breaking numbers over the past 2 years. And this is also supported by the Royal Institute of Chartered Surveyors, who have recently come out and said that new buyer inquiries were down 7% in May this year. So it certainly appears like the housing market is starting to cool. And look, it very much makes sense when we look at the broader macro picture, because there is huge uncertainty right now with the cost of living crisis. And as such, the broader macroeconomic environment will have a huge impact on home buyer demand. If we just think logically, interest rates are on the rise. We've gone through a period where the Bank of England have hiked interest rates from 0.1% to now 1.25%. Now let's say you're on a variable rate mortgage, or perhaps even if you're on a fixed rate mortgage but you're coming up for renewal. Just on the very bones of a mortgage calculator, forgetting any other kind of additional fees or charges, when you just look at a mortgage payment on a £300,000 mortgage at a 1.5% interest rate, which was certainly feasible when Bank of England base rates were 0.1%, that monthly repayment would be £1,200. Now, even if we just applied the additional Bank of England base rate increasing by 1.15%, then that would take your monthly mortgage payments from £1,200 to £1,369 with a 2.65% rate of interest. Now, £169 might not seem a lot for some people, but it still is a 14% increase on your mortgage payments every single month. Now, when you combine that with the potential of further interest rate hikes on the cards, which they certainly are, then it certainly doesn't look like a great situation. And on top of that, the energy price cap is also due to rise roughly about 46% in August, which obviously when you account for also moving house, potentially buying a bigger house, your energy prices are going to go up anyway. And along with that, the general cost of living is up at 40 odd year highs with inflation running at about 9%. So you can kind of see when we build this picture why the demand side of the equation may certainly be the underlying catalyst, which could certainly cause house prices to fall. Because, in my personal opinion, I think there's an element of nervousness in the property market right now. I'd like to think that people aren't stupid, but unfortunately many are, because they're paying well over the odds for the actual value of the property that they're purchasing, so much so that the banks are even now starting to step in and say, we're not giving you a mortgage for that property that you've agreed to pay for, because the property isn't worth as much as you think it is. Now, I guess the downside or the upside, depending on which way you look at it, to this is the fact that with such price extremity, it's actually starting to price people out of the market. And what I mean by that is when we look at the average price for a home right now in the UK, we're talking £295,000. And as this graph shows, since the late 90s, the price of a property compared to people's incomes has gone from in the realms of about 2 to 4 times earnings to now anything between 4 to about 20 times earnings depending on where you live. And truthfully, it's pricing people out of the market because income isn't keeping up with house price growth. And I think you certainly know when things are starting to get out of hand when the BBC starts to cover it.
Our main story tonight, priced off the ladder. The growing housing crisis for first-time buyers as the rising cost of property leaves more people unable to afford a home.
So it's certainly becoming increasingly difficult, perhaps even close to impossible for first-time buyers to actually get on the property ladder. Because whilst monthly mortgage payments are just enough in themselves, with actually a deposit on top of that to the tune of 10% of 295 grand, and you're talking about a deposit plus your legals of somewhere in the realms of probably about 30 to 35,000 pounds. So where does this all leave us? Will the property market eventually grind to a halt, causing property prices to absolutely fall through the floor? Or will this kind of property mania still continue to see property prices rise for the foreseeable future? Well, just like the stock market, the property market also goes through market cycles. And some people certainly subscribe to the theory of the 18-year property cycle. Now, in short, an economist called Fred Harrison actually analysed the property market for hundreds of years. And he came to the conclusion that the property market follows very distinct market cycles. And it always starts or finishes, depending on which way around you look at it, with some kind of market crash. Where, of course, the last property market crash that took place over here in the UK was all the way back in 2008, which as we all know now as the Great Financial Crisis. So with that in mind, now let's take a look at the cycle. So applying 2008 as the starting point, from year 1 to year 7 we see the recovery phase, which would take us up to about 2015. Then between year 7 and 14 we see an explosive phase, which would take us up to about 2024. Then between year 14 and 18 we see the recession phase, which would take us up to about 2028. Now in my mind, whether you believe in the 18-year property cycle or not, timings wise, it certainly feels quite accurate. When we look at the broader macroeconomic environment, the likelihood of a recession has certainly started to increase within the next 12 months. And due to the fact we've seen record property growth rates along with exuberant prices from people trying their luck, we could very much now be close to the end of the expansionary phase within the property cycle. And when I say close to the end, I'm talking probably within the next 1 to 2 years. Because fundamentally, when you look at all of the data, there's still a shortage of property supply along with still underlying demand too, which has certainly resulted in price forecasts for 2022 to still see property prices actually increase 8% within the year, but it will certainly start to slow down, with forecasts suggesting that we'll only see a 1% growth rate during 2023. So with that all in mind, there still certainly is a little bit more room for upside. But eventually, just like we see for all markets in a sense, we will inevitably see a market crash. So in the next crash, how much will property prices actually fall? Well, I'm certainly a numbers guy, and I certainly like to go beyond just the news headlines as a primary source of information. So taking a look at UK real house prices, obviously adjusted for inflation, since 1975, there have been 3 notable market crashes during this period. We had the one between 1979 to 1981, where the market fell 16.1%. Then we had another between 1989 and 1995, where the market fell 34.7%. And then finally between 2007 and 2012, where the market fell 24.5%. So if we take an average of the past 3 market crashes, it's a decline of about 24.5%, which based on our current average house price of just shy of 300k, it's roughly about a £75,000 reduction in the total value of the property. But will the property market actually fall that much? Well, it might not. It really is very much an unknown. But I think what I will say, the beauty of investing into a property or even having a residential property is that it's certainly a long-term game. Just like the stock market, time in the market is far more important than timing the market, because over time, historically speaking, UK house prices have always gone up in value. Now, if you guys thought that the property market was interesting, then you're probably going to want to take a look at what's going on in the stock market by clicking on this video here. And with that being said, I'll see you over in the next one.